from the New York Stock Exchange. It was a busy day on Wall Street. In light of the interest rate hike announcement, the Dow started the day in positive territory and then dropped right after the announcement at 2 p.m. But then the industrials swung positive in the back end of the day, up over 500 points.
Yeah, the S&P 500 and the Nasdaq both ended the day in green as well. The S&P is up around 2%, the Nasdaq more than 3%. Joining us now for more on this is Nick Timiraos. He's the chief economics correspondent at the Wall Street Journal and the author of $1 Trillion Triage, How Jay Powell and the Fed Battled a President and a Pandemic and Prevented Economic Disaster. And Nick, thank you so much for joining us. As we reported, the Federal Reserve raised the interest rates by 0.25 percentage point today. How is that announcement affecting the markets?
Well, thanks for having me. You know, it's odd because the Fed's announcement today, not just that they were raising interest rates today, but they put out projections showing that they think they're going to raise rates at every Fed meeting this year. There are 6 more meetings. The Fed hasn't raised interest rates that much in a year since 2005. And so seeing the market up, clearly there's a lot going on today. Investors may be reacting to developments in Europe. You saw oil prices down. So it may be one of those days where the benefit of lower oil is swamping the concern that you would otherwise see, I think, from having higher interest rates.
Yeah, Nick, it's an interesting statistic that you gave us that 2005 was the last time that there were so many interest rate hikes. And this is actually just the first of 7 interest rate hikes. So tell us what all of this means for the average American consumer.
Well, so the Fed is doing this because inflation's too high, right? And supply and demand are out of whack. That's why prices are up. The Fed cannot do anything about supply chain bottlenecks, about oil shortages. So the Fed's tools, you heard Jay Powell today say, we will use our tools to prevent inflation from being too high. He's saying that they're going to have to slow down the economy, potentially. And so the Fed can reduce demand, and that will mean fewer jobs. The Fed does not want to see wages run at levels that would push inflation higher. And so that's one way it'll affect American consumers. The other, of course, is that it is getting more expensive to take out loans. Mortgage rates are going up. Credit card rates are going up. We may see a little bit of an increase in yields on our savings accounts, but not very much so far.
So I've made this point all day saying that we knew this was going to happen. Chairman Powell had told lawmakers that he was expecting this 25 basis points in this meeting. But now with the war in Ukraine and other events happening around the world, does this change the plan for the Fed, and how much does it impact their thinking?
Yes. I mean, it creates a lot more uncertainty, for one. I think the more important point, though, is the Fed came into this year thinking that they would get a break on inflation soon, that the supply chain bottlenecks would ease, and that prices, particularly for goods like cars, which had seen extreme price increases last year, that you would get some help there, and that would bring inflation down. The war in Ukraine, the lockdowns in China interfere with all of that. And so, it's one thing to have a plan, but now the Fed has been punched in the face, and they're not going to get the help on inflation, at least as soon as they were hoping. Maybe they get it later this year. And so what that does is it forces them to say that they're going to raise interest rates more this year than might have been the case 2 or 3 weeks ago, before the war and before we had these new COVID lockdowns in China.
That's interesting, Nick. Interesting too. You're the first person I've heard describe it as being punched in the face. But it's been 2018 was the last time we had an interest rate hike. It's been all this long time. Inflation's been out of control. 2 questions. One, is the Fed late, really, in raising interest rates? Should they have been doing this sooner? And how is increasing the interest rate going to help the Federal Reserve combat this inflation?
Well, hindsight's 2020. If the Fed had known inflation was going to be this high at the beginning of 2022, then yes, they would have moved faster last year to remove stimulus. I'm not sure how much of a difference it would have made because, again, we had things from the pandemic like shortages for semiconductors that were driving prices higher. I think the challenge now for Jay Powell and the Fed is, if you think back 2 years ago, in fact, it was 2 years ago today that the Dow fell 3,000 points, America was locking down. And I write in my book about how Powell, groused to his colleagues that he felt like they were falling behind. He wanted them to catch up. He said, it feels like we are swimming after a speedboat. And they did catch up. They got ahead by taking very aggressive measures. So the question now is, can the Fed get into the right gear here where they're raising interest rates faster to put the economy in a better place to slow down inflation, but without going so hard and so fast they cause a recession? Powell was asked today about recession risks, and he said he didn't think a recession was likely in the next year. But you never really want to hear the Fed chairman being asked about a recession.
Yeah, that came up, and also concerns about a recession have been growing. What about you? Are you concerned that can happen in the short term?
Well, if you listen to what the chair said today, he's pointing to a strong labor market, a strong economy. That's all true. But he was also saying that the labor market's too tight. And the way that the Fed deals with that is to raise interest rates to increase unemployment. And usually when you increase unemployment a little bit, you increase unemployment a lot because we have a recession. So that is the challenge for the Fed. Can they slow the rate of growth in the job market? Can they get more people to come back into the job market so that wage pressures aren't as intense as they are right now? If they can do that, then yes, maybe we have the soft landing, but soft landings are rare.
All right. Nick Timiraos, thank you.
Thanks for having me.